So much for tuning into Talking Point. I'm your host, Niraj Shah. It was the fifth sequential quarter of margin expansion as I read it for KPIT Technologies, and the 11th consecutive quarter of increase in net cash. The fact that they did a 4% revenue growth quarter on quarter with an EBITDA margin expansion as well as an 8% PAT growth also led them, I reckon, to increase their guidance for the current year, both on the revenue front as well as on the EBITDA margin and the EBITDA front. To talk about the quarter gone by, the developments that happened in the quarter gone by, and the outlook ahead. Joining us on the show is Mr. Kishor Patil, co-founder, MD, and CEO of KPIT. Mr. Patil, good having you. Thanks for joining in. I hope all is safe.
Absolutely. Good morning, Niraj.
Yeah. So talk to us about the quarter. You obviously did a few things right. We'll talk about the manpower issues as well. But healthy revenue growth, and despite wage hikes, I presume, despite wage hikes, an expansion in EBITDA. What went right this quarter?
Yes. So let me just first start talking about few points which will lead to some of the answers I'm giving. Number one is, as you know, the year-on-year, the quarterly growth is 23%. So it has been a big driver also from the having a consistent growth, at least 4 to 5%, at least some quarters have been more. Every quarter. So I think that has certainly having that kind of a visibility has helped us to manage the cost, certainly. The second important point is we know that the areas in which we are working is going to provide us a long-term growth. We see that this kind of trend over next 4 to 5 years. So we are in a better position to plan. That is the second part. The third part, which is very important, is if you look at our growth, most of the growth over the last year, even if you see, largely coming into fixed price projects. That gives us many more, if I have to say, levers. One is, of course, better rate realization, managing the mix between on-site, offshore, or some of the costs. The third thing is, if I have to say, monetization of our assets. Because as you know, we have the platform tools and accelerators, so we can actually use some of the assets where we have invested as a reuse in terms of client engagement. I think all this has led to this growth, and of course, I need hardly say about operational efficiency. Now, that of course is a driver. Now, what has happened is. This quarter was a special one, and we are very happy we could demonstrate the growth as well as in the margin profitability this time. Basically, we have given substantial increments as well as incentives. So we have given increments during the quarter, but also we have given a medium-term incentives to our employees, some type of employees. And that is a substantial amount. And I think in spite of that, we could demonstrate the growth in profitability is satisfying to us.
Yes, indeed. Actually, since you brought that up, I'll come to the revenue part in a bit, but just let's talk about this piece on margins and human resource. What clicked in terms of taking margins higher despite these wage hikes that you're speaking about?
Yeah, as I mentioned to you, basically having a better flexibility in managing the costs. So these are more fixed price projects. So 2-3 things which has happened. One is our per person realization has gone up every quarter. So one of the main reason has been that we have been in a position to reuse a lot of things which we have built. That has certainly helps us specifically in the fixed price projects. Secondly, our rate realization has been better. Certainly, it has been a better rate realization overall per person, and that has helped us. And the third is, of course, operational efficiency. And I think in some way, good or bad, as you know, the attrition is a very important problem across the industry. Because of that, to some extent, we had I may say, limited bench during the quarter. That to some extent helped, but that is not the main contributor. But certainly all these things help to some extent.
Am I reading quote unquote pricing power in your answer?
In some sense, yes. Absolutely.
And you reckon that can last?
We believe it can, basically because what we are trying to do, the business model is the client doesn't pay much more. He does pay a little more than competition because we can provide it in a quicker way, better quality. Our expertise is recognized. So that is there. But the second thing is, it is not also very significant because we are monetizing the assets and the investments we have made in the past.
Okay. The other aspect, Mr. Patil, which after your answer kind of not befuddles me, but amazes me, is that you have spoken about right now giving mid-quarter increases to select people. You have given increments which will last for quarter 3 and quarter 4. And if the bench was not fully occupied in quarter 2, which leads me to believe that hiring may step up as business picks up in quarter 3 and quarter 4, ideally manpower costs should go up. And yet you've spoken about an increase in the annual EBITDA margins.
That is true.
Is pricing power and higher business again the reason? What prompts you to do this despite all the factors that I mentioned?
No, I think we see a growth momentum, right? So typically, if you look at H2 is a softer quarter for most of the industries in the services, but we see continuing steady growth, what we have seen. And that basically allows me to absorb this cost.
Fair call. Let's talk about business. What is it that clients are telling you? Because the last 2 quarters that I've spoken to both Sachin as well as Kishor Patil, it seems to be the case that more and more clients are coming up for innovative solutions, and you are probably amongst the few in the industry across the world which is providing this service to the top 25 vendors. Tell us, how is the business looking? How is momentum looking? What kind of order flows do you expect? Not just in terms of numbers, but the type of orders that you expect in the second half.
Let me take a couple of examples which we have also talked about during this quarter. So undoubtedly, electrification is the biggest area of spend for all OEMs. You might have seen all the announcement from them. And so do we. And we are engaging in most of these on a platform basis, not on a project basis or a program basis, but more on a platform basis. That gives us ability to really work on 4 to 5 years, which is like a 2025, 2024, 25, 26 programs. That gives a long-term engagement in a strategic manner because you are owning most of the deliverables. So I think that is there. And the one announcement which we have done during this quarter is similar from another OEM from Europe, which is 52 million plus. So I think this is certainly a very important as well growth driver for us, electrification. Naturally, there are other areas, and what we have done is we are actually looking at expanding the scope of our offerings beyond what we have. And basically, because we are focused on a vertical, we have naturally there are sub verticals. As you have seen, the commercial is growing faster, car is there, new mobility is there. So what we intend to do is also increase the expand the offerings which we have. And that's how we increase the slit or the market on which we are trying to really address for these clients, T25, to your point. And I think that gives them a value. So one announcement we have is, for example, development cooperation with ZF. Now, development cooperation for ZF, what is this about? So there is a significant change in the technical architecture of most of the cars, which are going to come in 2024, 25, 26, and depending upon the client. And this is not a trivial thing. It requires a lot of investment. Secondly, what is going to be difficult for them to is actually deliver it during that time, a reliable product. Because this is not good enough time for them to develop their own software, have it tested, and specifically because this is not an application development. This is at a operating system middleware architecture of the car. So this is not I would say, a normal application. Now, in order to do that, and in order to have give them this kind of a solution, we had a development cooperation with ZF. which is naturally a very well-known company in this. That allows us to really test these products, or develop, also leverage each other's expertise and each other's strengths to bring this kind of a solution. Now, this kind of collaboration, this kind of partnerships, this kind of offerings does expand our market place. So that is what we are trying to do.
Okay, I have a follow-up on the powertrain win that you spoke about, just a brief bit. But before that, since we're talking about the ZF thing,
yes.
So since you did that, I believe mid-quarter or towards the end of Q2, and I heard you mention that this, for both the parties involved, opens up newer players and newer markets. Can you give us some color of what kind of, I mean, you would have gone into this thinking that as a result of this deal, you would get certain specific kind of clients from certain specific kind of geographies of certain specific sizes. And at the same time, I've heard you mention, you and KPIT mentioned in the past, that you want to ideally focus only on the top 25 vendors or top 25 car makers in the world. So give us some sense of how this will shape up.
So what will happen? Yes, certainly. So if you really look at the overall development of this middleware as well as the new architecture, I think the kind of spend is very significant for the OEMs. It is in billions. And more importantly, it takes time, much more time to develop it. And you may not get those kind of people. There are not those experts available for every company. So I think it may have happen with maybe top 5, 6, 7 OEMs who have the resources and that strength and expertise to really do that. So our focus on this kind of our clients, which are most of them are a part of our T25, is to really develop a customized solution for them by using the assets which we have, which we talked about a little bit earlier. And we bring it, so we accelerate it. And to some extent, we can give them a different business model so that they don't have to make upfront investments. That is for first 5, 6 large players. The rest of them, I think they may, and this is what we feel right now, we feel that they may go for more, if I'd say, cooked solution, more prepared solution. And that in that case, we can come back to them with these offerings, which is a highly reusable kind of a solution. So that is what we intend to do with most of our clients. With this.
So let me rephrase my question, Mr. Patil. What was the quarterly run rate of deal wins? I know you announced one large and a few others, but what's the average quarterly run rate? And do you expect that if not in FY22, then in FY23, as a result of ZF and a few other collaborations, the average quarterly run rate could move up?
So as I mentioned to you, first we see a very clear trend of higher spend of technology in next few years. So we see that, and that's the bet we had taken, and that's why we are so focused and we are working on this. So certainly it is like that. Secondly, we don't give the exact number of the pipeline, but I can only say that it is again much stronger. So the pipeline has gone up over last quarter substantially. But to your point, will it accelerate for the next year? Our early indications that there are many conversations we are having which are not reflected into the pipeline right now. But over the next 4 to 6 weeks, I think 4 to 6 months before March, I think most of these will become more tangible and will form a part of pipeline. That should help us in acceleration, but we'll have to wait for next 4 or 5 months to see how the clients behave.
So over the next 4 to 6 months, there could be some client conversations which could materialize into orders. There could be maybe some more tie-ups, and looking at the war chest that you have, some acquisitions as well.
Certainly. So actually, as I mentioned to you, we are expanding the areas in which we operate for mobility industry. We have a lot of expertise, but we want to really make sure that we have more and more solutions for our mobility industry as they are transforming themselves, both in terms of technology as well as their business model. So in that process, we believe that there may be certain areas as well as for a certain expertise and talent we may acquire companies, and we certainly have demonstrated a very significant cash generation over last few years. And we believe that that will only accelerate what we are doing, So certainly we are looking for it, but we are very, as you know, we are very careful of what we will do. Because most of the client access we have, we are in most of the domains. We can build in this area technology quickly. So unless we see some very tangible benefit as well as complementary offering, which will really reduce the time to market for us and for our clients, we won't do it. So in those kind of situations, we believe we will be in a position to do some acquisitions in that area.
So could safe to assume that it could be of the nature of small tuck-in acquisitions as opposed to large ones?
Yeah, it won't be any mega acquisitions or anything, but this could be anything between 20 and 60 million kind of.
Okay. Fair call. Mr. Patil, just revert back to pull back to the manpower issues, because that seems to be the central point for most tech companies. Though you are not technically an IT outsourcing company in the truest sense, but I'm still asking you, because I think the talent that you have could be sought by both auto companies as well as IT companies, right?
What
was your attrition? Sorry, what was your attrition this quarter, and how do you propose to manage that?
Yes, certainly. So we don't consistently report on this number, but let me tell you that it was higher, and it is more than 20%, and it went up during this quarter. So both this statement I can make. So our attrition was almost in single digit few quarters back. So we have taken very clear measures to do that. Now, as you know, it is not a phenomena specific to a company, not a specific geography. It is across the world it is happening. But we believe that we have taken some very strong steps. 2-3 things. First is naturally we have increased, and specifically because of the focus, we are in a position to attract good talent across the globe. So we have increasing our footprint from where we will hire, both within India and outside India. So that is one point we are doing. So we have substantially increased our capacity to hire. That is one thing. The second is we substantially increase our ability to build a competence in our domain. That is the second part which we have done. Third thing what we have done, which is significant, is I think our increments as well as the incentives together is one of the best in the industry. And we have tried to really make a significant change. It is not an incremental change in terms of compensation, not only just a pure increment, but midterm incentives and etc. So we have done that. So that would obviously reduce that. But at the same time, what is more important for us is we believe that creating a visibility of career growth and specifically working on the exciting technology is very important for many of the techies. So I think that is what we are communicating and giving them the visibility. I think with all this, we believe we should be in a position to get it under control by March.
As I think Ravi Pandit was telling me, it's probably the best time to be a tech expert, because companies are wanting every piece of you. One final question. You've raised guidance for FY22 based on the order book that you have. Even if things were to maybe not heat up, if you will you believe the exit numbers show that at least growth for even FY23 might continue to be robust? Because as I heard you say, there are some 5-year deals, there are fixed price contracts, etc. You may not give me an exact number, and this may not be the time to talk about FY23. I'm just trying to understand, because people are discounting 3, 4, 5 years numbers. Do you reckon you yourself have that vision or the visibility?
Yes, certainly. I think we see that robust demand environment will be there for next 4 or 5 years in this industry for sure, if not beyond. So we are certainly, that's why we are trying to make sure that we cover all the spaces in the focus area which we have identified. So we feel good about the demand environment.
Well, splendid show this quarter for sure. Thank you so much for speaking to us today. All the best for the quarters ahead. And from all of us in the BloombergQuint family to you and the KPIT family, a very happy Diwali and a prosperous New Year, Mr. Patil.
Thank you, and have wish you very best festive season to all of you. Thank you.
Thank you so much. Viewers, thanks for tuning in.